You don't really need brains.
What do you need?
You need the right orientation. 90% of the people, I'm pulling a figure out of the air, but 90% of the people that buy stocks don't think of them the right way. They think about something that they hope goes up next week. And they think about the market as something they hope goes up. And if it's down, they feel worse. I feel better.
And you think about?
Pardon me?
And what do you think about?
I think about what the company's going to be worth 10 or 20 years from now. And I hope it goes down when I buy it, because I'll buy more.
Inspired by the investment wisdom of Warren Buffett, in this video, we're introducing an easy 3-step strategy that's not just for the wealthy, but for anyone looking to multiply their savings, no matter how small. Whether you're starting with $750 or any amount, the principles of growth remain the same. However, the approach you take depends significantly on whether this $750 is your starting point with more to follow, or if it's a one-time investment. If you plan to invest this $750 and let it sit, expecting it to transform into a fortune, we need to recalibrate expectations. It is true that investing, even with a small amount like $750, is a good way to start building wealth. But the road to real wealth takes more than just patience. It takes strategy, insight, and sometimes a reality check on the returns that different investment vehicles can offer. Let us start with one-time investment options for $750. When it comes to the bedrock of financial safety and accessibility, savings accounts stand out. They offer a secure place to stash your cash, with the added benefit of earning interest over time. However, if you're aiming to turn your $750 into a substantial nest egg, the reality of savings account returns might prompt you to reconsider. As of March 15, 2024, the national average yield for savings accounts has been reported at 0.57% APY, according to a recent survey by Bankrate. This is a slight uptick from the historically low rates of previous years, but it's still far from a wealth-building powerhouse. Let's break down what this means for your $750 investment. Over the course of 1 year, your investment would grow to approximately $754.28. Fast forward 5 years, and with the power of compound interest, your initial deposit would only reach about $764.25, assuming no additional contributions are made. This scenario highlights a key point. Savings accounts offer unmatched safety and liquidity, but their return rates are not designed for wealth accumulation. The modest growth of your investment over 5 years illustrates that, even with slightly improved interest rates, parking your money in a standard savings account won't catapult you to financial prosperity. Let's move on to the next option on our financial journey: certificates of deposit, commonly known as CDs. Now, CDs have always been the go-to for those looking to earn a bit more than what a traditional savings account offers without stepping into the volatile world of stock markets. But the big question remains: can investing your $750 in a CD turn it into a significant sum over time? Let's study the numbers and see what the current landscape looks like. Recently, CD rates have seen an uptick. As of March 2024, 1-year CDs offer an average of 1.78% APY, while 5-year CDs sit at 1.44% APY. So what happens to your $750 in this scenario? Placing it in a 1-year CD at 1.78% APY gives you about $763.35 by year's end. Opting for a 5-year CD at 1.44% APY, your investment grows to roughly $803.62. While these are safe guaranteed returns, they highlight a point. Even with better rates, CDs alone won't turn your $750 into a fortune. After 5 years, the growth is modest, far from transformative wealth. Now let's take a look at the stock market, a more dynamic investment option.
90% of the people, I'm pulling a figure out of the air, but 90% of the people that buy stocks don't think of them the right way. They think about something that they hope goes up next week.
Now, the stock market is known for its potential for high returns, but also for its volatility. But what if we were to assume a hypothetical scenario where you could achieve a consistent 20% annual return on your investment? Sounds kind of dreamy, doesn't it? Let's see what it would mean for your $750. Investing $750 in the stock market with a 20% annual return sounds like a fast track to wealth. After 1 year, your investment would grow to $900. Continue this growth for 5 years, and you're looking at approximately $1,880.96. That's more than double your initial investment, and on paper, it looks fantastic. But let's put it into perspective. While the 20% return is significantly higher than what you'd get from savings accounts or CDs, the reality is that achieving such a high return consistently is incredibly challenging, even for seasoned investors. The stock market can be unpredictable, with many factors influencing returns. Moreover, while turning $750 into nearly $1,900 in 5 years is impressive, it's more important to ask ourselves, is this a path to true wealth? The answer for most people is no. While the stock market can be a powerful tool for wealth creation, relying on a single investment of $750, even with high returns, is unlikely to make you wealthy. Wealth accumulation requires a combination of consistent investments, diversification, and time. So where does that leave us? If you're starting with $750 and looking to significantly increase your wealth, the key is to find ways that grow that initial investment into a larger sum that can then be diversified across various investment opportunities, including the stock market. Once you've grown your initial investment, the stock market becomes a more viable option for part of your investment strategy, allowing you to take advantage of compound interest and potential returns over a longer period. Remember, the goal is not just to invest, but to invest wisely and consistently, increasing your contributions over time to build a substantial portfolio. Now let's dive into how you can actively grow your $750 investment by focusing on personal development and entrepreneurial ventures. Warren Buffett, the Oracle of Omaha, famously advocates, invest in as much of yourself as you can. You are your own biggest asset by far. Charlie Munger, his right-hand man, also stresses the importance of lifelong learning and skill acquisition. Their wisdom underscores a powerful strategy for financial growth, enhancing your value and generating income through side hustles. Imagine using part of your $750 to enroll in a comprehensive online course on digital marketing, costing around $200. This investment in yourself equips you with high-demand skills in a growing field. With these new skills, you decide to start a freelance digital marketing service. Initially, you secure small projects, each bringing in an extra $300 per month. Within just 3 months, not only have you recouped your initial investment, but you've already started generating a steady stream of additional income. Let's break the numbers down further. After recovering your initial course investment in 3 months, every dollar you earn from your side hustle represents a direct profit. If you continue to earn $300 per month from freelance projects, that's $3,600 in a year. This is a simplistic example, but it illustrates the potential return on investing in yourself and starting a side hustle, compared to the modest growth offered by traditional savings or CDs. Furthermore, suppose you allocate another portion of your $750 to create a passive income stream, such as developing a digital product that you sell for $50. If you manage to just sell 2 units per month, that's an additional $100 monthly without ongoing effort. Over a year, this passive venture alone could bring in $1,200. Combining these efforts, your initial $750 could feasibly help generate over $4,800 in a year through active and passive income streams. This doesn't even account for scaling your ventures or reinvesting some of your earnings to grow your business further. Buffett and Munger's teachings remind us that the path to wealth isn't just about where to put your money. It's also about how you can increase your capacity to earn. By investing in skills that are in demand and leveraging them to help create income streams, you're not just working for money, you're making money work for you. Now that you've begun actively growing your initial investment and have started generating additional income, it's time to consider expanding your investment portfolio even further. One attractive option is to explore real estate investment without the traditional route of buying property outright. Real estate investment doesn't always necessitate owning physical properties. Thanks to the rise of crowdfunding platforms and real estate investment trusts, you can dip your toes into the real estate market with as little as $1,000. These innovative investment vehicles allow you to participate in real estate ventures without the need for a substantial upfront investment. With crowdfunding platforms, you can join forces with other investors to collectively invest in real estate projects, such as residential developments or commercial properties. By pooling resources, you gain access to opportunities that may have been out of reach individually. Plus, you can diversify your investments across multiple projects, spreading risk and potentially increasing returns. On the other hand, REITs offer another avenue for investing in real estate without the hassle of property management. These investment trusts pool funds from numerous investors to purchase, operate, and sometimes finance income-generating properties. As a shareholder, you benefit from the rental income and property appreciation without the responsibilities of landlordship. Both crowdfunding platforms and REITs provide avenues for passive income through rent and property appreciation. By investing in these real estate vehicles, you can diversify your investment portfolio beyond traditional stocks and bonds, potentially enhancing long-term returns and mitigating risk. The next logical step in your investment journey, once you've established recurring funds for investment, is to consider the stock market. Buffett famously quipped, "A low-cost index fund is the most sensible equity investment for the great majority of investors." This sums up his belief in index funds for wealth accumulation. However, rather than opting for individual stocks, a wise choice is to invest in index funds. Why? Because index funds offer several key advantages that align with your financial goals.
I mean, the game is very, very, very easy if you have the right lessons in your mind about what you're buying. I'm not buying stocks. I'm buying pieces of overwhelmingly American business, and I'm happy.
Firstly, index funds provide instant diversification. By investing in an index fund, you gain exposure to a broad range of stocks, often spanning various sectors and industries. This diversification helps spread risk across numerous companies, reducing the impact of any single stock's performance on your overall investment. Secondly, index funds typically have lower fees compared to actively managed funds. Since index funds aim to replicate the performance of a specific market index, such as the S&P 500, they require less active management. As a result, they tend to have lower expense ratios, allowing you to keep more of your investment returns over time. Moreover, index funds offer simplicity and accessibility. They are easy to understand, making them suitable for both novice and seasoned investors alike. Additionally, many brokerage platforms offer commission-free trading for index funds, further lowering the barriers to entry and allowing you to invest with ease. Perhaps most importantly, historical data consistently demonstrates the long-term success of index fund investing. Over time, broad market indexes like the S&P 500 have shown steady growth, outperforming the majority of actively managed funds. By investing in an index fund, you align your strategy with the overall upward trajectory of the market, increasing the likelihood of achieving your wealth accumulation goals. Overall, index funds offer diversification, low fees, simplicity, accessibility, and a proven track record of success. As you continue to build your investment portfolio, allocating funds to index funds can be a strategic move towards long-term financial growth and stability. In closing, as you set out on your financial journey to multiply your $750 investment in 2024, remember that the key lies in informed decision-making and strategic planning. Which investment option resonated with you the most? Are there any strategies you're eager to explore further? Share your thoughts in the comments below, and let's continue the conversation.